Good morning, everybody. For those of you that aren't familiar with my voice from our last two webinars, I'm Kristan King, a director in the KPMG Isle of Man advisory team. Today, I'm welcoming you to the last in our current series of 3 webinars aimed at matters that we expect to be particularly relevant in the local TCSP sector in the coming months. For those of you that weren't able to join us, and I hope you had a good excuse, last week we talked about considerations in relation to solvency and insolvency, and in the previous week we discussed directors' duties and responsibilities, both of which are particularly important at the moment. In today's session, we're going to look at investment valuations, with the principles applying both to your own investments and to those of your clients in the entities that you manage. Whilst this might seem to be a technical session for the accountants amongst us, I would say that for directors of investment companies, the valuation of investments will always be a key area. And it's important that you understand and monitor the approach to valuation that's being taken. Given the economic impact of COVID-19 at a macro level and at an individual company level, in many instances, the process of valuation of investments is likely to require greater consideration this year. As this is also an area often involving significant judgment, we think that it's worth recapping on some of the basic principles that apply, whilst also considering whether the volatile investment markets and potentially variable economic trading conditions should materially change your approach to valuations at this time. As usual, a quick bit of housekeeping, but before we start, hopefully you've been joining all the webinars, so you're familiar with how these work, but to quickly recap, if you wish to submit questions today, please do so in the chat function of the webinar or submit them to webinars@kpmg.co.im. We'll try to respond during the webinar, but if we're short of time or if your questions are too difficult, we'll respond subsequently. The webinar is being recorded and will be available later today on our website if you wish to revisit parts of it or share it with your colleagues. For today, I'm joined by Ed Houghton, a director in our audit department with a number of TCSP and fund audit clients for whom valuation related matters are material. So to start us off, I think it's worth recapping on how IFRS 13 defines fair value, just to set the context for today. The price at which IFRS 13 defines fair value as the price at which an orderly transaction to sell the asset or to transfer the liability would take place between market participants at the measurement date under the current market conditions. So the conditions at the measurement date are important. And this means that for the near future, at least, just how difficult your valuation exercise may be could be determined by pure chance of timing. For 31 December 2019 balance dates, COVID-19 had really yet to strike. And by the next year end, we may have a better picture of the nature of the economic recovery that's expected. And you'll have greater evidence of how the changes in conditions have actually affected the businesses that you're trying to value. However, if you're just about to perform valuations as at 30th of June, then you may be dealing with much greater uncertainty. And so you're going to have to exercise considerable judgment. IFRS 13 goes on to say that fair value should be based on the principal market for the asset or liability, or the most advantageous market in the absence of a principal market. When a price for identical asset or liability is not observable, this most often means when you're trying to value an asset that is not a listed security, an entity measures fair value using another valuation technique that maximizes the use of relevant observable inputs. When referencing relevant observable inputs, this is generally intended to mean publicly available market data, such as trends in market capitalization of peer companies or their enterprise value expressed as a multiple of their profits or revenues. These inputs could be quite variable. And for those of you that joined our new reality webinars last Wednesday or yesterday, you will have seen the trend in equity prices throughout the first half of 2020, with significantly sharp decreases of in the region of 30 to 35% in major indices at the end of March and into early April, with a gradual recovery seen thereafter. So if you were estimating the fair value of an investment at 31 March 2020, you may have written down the value significantly, particularly for listed securities, or if for private investments, you took market data as at the measurement date without any further considerations. This may not have felt like an appropriate fair value given your expectations of the long-term performance of the investee company, and therefore the price you think that a market participant would be willing to pay for the asset. IFRS 13 does state that consideration should be given to the perspective of the market participants that would operate in that market. So this does give you some opportunity to look through short-term securities market trends if you're looking at private company investments. The International Private Equity and Venture Capital Valuation Guidelines are seen as a key source of guidance for valuers of what we call level 3 investments, being those for which there is not an observable market for similar assets. In most cases, private company investments would be the typical investment class that we would see our TCSP clients dealing with. The IPEV guidelines are strongly based around the requirements of IFRS and US GAAP, and were developed to help the private equity industry to provide sufficient, timely, comparable and transparent information, including financial statements that are consistent with accounting standards. As such, the basic concept of fair value is the same as for IFRS 13, and the IPEV guidelines are certainly worth reviewing if you're not familiar with them. For level 1 investments, or the actively traded or quoted securities, the available market prices at the measurement date will be the exclusive basis for measurement of fair value for identical instruments. As such, if these are your principal investment class, then the good news is that you don't have the same concerns regarding the use of judgment. But the bad news is that you may have to reflect some significant changes in value that you may not always fundamentally believe reflect the value of the investment over your intended hold period. Level 2 investments are those that are most often listed securities or fund for which the market is not deemed to be sufficiently active for the investments to be considered as level 1. So market data will still be the principal source for the valuation. For example, a last traded price, but perhaps not at the measurement date. But you'll need to thoroughly document why you believe the market data remained valid at the measurement date, or indeed why you believe that it was no longer valid at the measurement date. And this can be more difficult when market conditions are generally more volatile as they are at the moment. For level 3 investments, most often private company investments, the key messages running throughout the guidelines are that whilst there will always be judgment required, it's important to adopt an appropriate technique for valuing a particular investment and to be consistent in your approach. However, it's also emphasized that you should maximize the use of market observable inputs still. This is with the intention of removing some of the individual judgments or variations that may be contained within your valuation. So you'll still need to spend some time considering which market observable inputs are most appropriate for each investment. And it's this area that we'll go on to explore today. But first, at 31 March 2020, IPEV issued a special guidance note in response to the economic impact and volatility of investment markets caused by COVID-19. In essence, this reiterated the need to stick to the existing principles, including consistency of valuation techniques and ensuring that valuation processes are robust. They reiterated that fair value is based on what was known and knowable at the measurement date. So you cannot, or perhaps do not, have to revisit your valuation with the benefit or potentially the cost of hindsight. They also reminded us not to rush to fire sale values, but to properly consider the prospects of the investee company and consider fair value as appropriate. So if we turn to some of the potential impacts of the current economic conditions, the value of any business, product, or possibly intellectual property that your client may have invested in is clearly linked to its future economic performance, no matter what your basis for valuation. So, as highlighted by IPEV, this doesn't necessarily mean a rush to fire sale values. When considering valuation in the current environment, your first reaction may be to focus on the general downturn in economic performance, that's been caused by the COVID-19 shutdowns around the world. Assume that this will apply to all of your client investments. However, as with any period of economic instability, the impact on any specific business is likely to be just that, fairly specific. Different sectors will experience different impacts or benefits at different points in time and for different periods of time. As a general rule, it is of course likely that an economic downturn will adversely impact many businesses. Clearly, the travel sector, the air travel in particular, has been affected and appears likely to remain so for some time. This has had knock-on effects on the aircraft manufacturing and service segments and their supply chains. It's too early to tell whether consumers choose to take this forced reduction in their air travel as an opportunity to change their habits for good, with perhaps environmental matters in mind, or perhaps as a result of being reminded that staycations aren't that bad. Although some of you may disagree if, like me, you've been forced out on family camping trips recently. This can also be seen in the UK retail sector in particular at the moment, with many of the larger organisations choosing not to reopen all of their outlets. We've seen John Lewis, Pret a Manger, and this morning Burger King announce that some of their outlets will remain closed, whilst TM Lewin, selling office wear on almost every high street, has announced that the business is moving entirely online. These sorts of changes will have knock-on effects upon the commercial property sector, and we've already seen Intube go into administration. This is likely to be an area that affects many TCSPs locally, given the extent of property investment into the UK via the Isle of Man. However, there are, of course, businesses that have experienced phenomenal benefits as a result of COVID-19. Those businesses with the best online offering have fared better, and those businesses that have enabled remote working and communications have benefited even more. Zoom will be one example that many of us will be familiar with, but companies providing system security and monitoring, hosting services should also have experienced benefits as their corporate clients have had to lean on them for greater support. And of course, webinar platform providers will have done well as well, if only I'd invested in those. In terms of changing priorities, I was thinking here of governments, and in particular, where resources have been diverted towards reorganisation of hospitals and other care settings to protect against the spread of coronavirus. This is ultimately likely to be at the cost of other areas of spending at some point, either elsewhere within health and social care or in other departments altogether. Schools have invested in greater online working capabilities, but this will divert from spending on will this divert from spending on school buildings or teachers themselves? Some companies will do well servicing the public sector as facilities are adapted, and if they're able to assist with that adaptation. But there'll be a mix depending on which departments and which initiatives your investment companies may be involved with. The last bullet on the slide was really aimed at an example of the pharmaceutical sector, where significant sums are being invested in identifying treatments, cures, or vaccines for COVID-19. But the economics of developing a successful solution for such a global problem are likely to differ to those experienced historically, as the morality of making a significant profit on such a product is likely to be questioned even more than normal when a drug is eventually launched, hopefully. So assumptions based purely on historical experience may require revision in some instances. Hopefully these points help to highlight that valuations need to consider the specific factors of the investee company and its markets. And whilst the variability of experiences may be heightened during times such as these, the points also stand up in what we would consider normal times. I think at this point, it might be useful to think about specific asset types and approaches to valuation and how they may be affected in the current environment. So Ed, would you like to take us through some of these considerations, please?
Thanks, Kristan, and good morning all. As Kristan has touched on, the considerations that we've started to explore are typically considered in the context of private company equity valuations. However, the same approaches and considerations are very much relevant when thinking across other assets and classes and concluding on their carrying values in the financial records of your own companies. As we know, there's been significant volatility and decline in a number of asset classes, driven by a decline in the earnings outlook, and there is continuing uncertainty about further impacts that may unfold, causing increased level of judgment and estimation that requires further thought when considering values. The key is to ensure that all valuations are updated to reflect the current circumstances, changed environment, and more uncertain and possibly weaker economic outlook, as Kristan has touched on. For example, considering how goodwill and intangible assets previously recognised are supported, as it is clear that there are indicators of possible impairment as a result of the changed economic outlook at the current time. What was previously reasonable may well have changed. Thinking about impairment indicators, there is an increased risk to a number of businesses, goodwill and intangible assets, as both value in use and fair value less cost to sell could have seen disruption. If we think about the approaches that can be adopted in valuation, there are typically two. The income approach, a value in use, forecast financial information to be adjusted for current or forecast trading conditions and the increased risk environment. And the market approach, using external market inputs and comparable evidence to support the valuation. Both of these will have been impacted by the volatility that's currently being seen. Therefore, it may be necessary to revisit financial planning and forecasting assumptions, as well as the risk environment and risk rates in order to perform impairment reviews. It may also be necessary to perform sensitivity analysis of core assumptions to consider the impact of reasonably possible alternative assumptions in order to understand where break-even points are and how, should these events occur, what the impacts would be on the business, especially bearing in mind the continuing levels of uncertainty surrounding business as usual, depending on your sector of involvement. And Kristan will discuss some of these considerations further in a moment. Whether there is an increased risk of default, and also these themes are equally relevant to considering loans and receivables. Whether there is an increased risk of default can impact across many sectors, not just banks and financial institutions as lenders, but as normal intercompany and group receivables that may be part of your overall exposure to an underlying business or investee, and equally as trade receivables through increased risk of counterparties and their businesses. Given the current environment, there is likely to be an increased level of default and delays in customers settling outstanding balances, which will impact on cash flows. As such, it is important that businesses continue to actively monitor current counterparty and credit risk when assessing exposures. This will require an active assessment of the wider economic environment, available information on, and the financial position of counterparties, as well as their ability and willingness at the current time to settle receivables in a timely manner, and how that should be reflected into a company's risk assessment, recoverability, and in turn, provisioning levels. Kristan also touched on investment property a moment ago. It is important to consider the key drivers of the investment property valuations that are owned, and where appropriate, obtain market and/or specialist input. There are a number of relevant factors to consider, such as the nature and location of the property, its sector exposure, and perhaps its fitness for purpose for new ways of working by existing and future tenants, which may impact demand and therefore future rental levels. The strength of existing tenants, are they able to pay? Will they pay? The lease tenure and future vacancy periods, or rental concessions such as rent-free periods or capex incentives that may be required to induce tenants to populate the property, or capex requirements that might be required from you as an owner to repurpose and improve the property itself. And also, from a market perspective, the impact on discount rates for future cash flows if there's a heightened degree of risk attached to them. These considerations would all be relevant in normal market conditions, but in the current rapid state of change, combined with weaker economic outlook, the assumptions used in these areas could drive material changes in valuation. And this has recently been highlighted by the RICS guidance issued directing the implementation of material valuation uncertainty clauses in property valuations performed at the current time, to highlight the increased risk and judgment used by practitioners in the current environment and possible limitations in comparable transactions for benchmarks given the evolving circumstances. Where these are included, it is important to note that it isn't a limitation on the valuation itself. It's just a highlight of the circumstances under which the valuation is being performed. And the valuation itself is subject to more judgment and estimation than usual, and possibly suffers from being outdated in a shorter than normal time frame. And as such, it's important that you continue to monitor how the valuations itself reflects current experience, understanding the basis of preparation, the assumptions that have been used, and how these compare to reality. As with private investment valuations, it is important to note that property market fair values are from the market participant perspective, rather than how you may view the worth to the business, or whether you would be prepared to trade in the assets at those prices. As a result, we would expect that there will be increases in disclosures regarding the basis of valuation, the key assumptions used, and also possible changes in key assumptions. And this should be considered throughout, where possible valuation assumptions and approaches are used, and there are possible alternative assumptions, in order to provide users with an understanding of the judgments that have been made, the range of possible outcomes, and allow their own judgments or adjustments to be factored in. It's equally important, where we have these asset holding vehicles, to consider leverage and how the asset valuation will interact with those existing leverage requirements and possibly future requirements. For example, are there covenant requirements that have an interaction with the asset carrying value? In the sense of investment property, we frequently see loan to value covenants, where the loan cannot exceed a certain proportion of the value of the property, or possibly the overall leverage or gearing compared to turnover or profits. If business activities such as turnover, profit, or cash flow have been impacted by recent events or are likely to be impacted by a weakened economic outlook, and how might these impact on both real debt service obligations, i.e. the ability to meet contractual interest and capital repayments, possibly the activity within the market and the ability to realise the asset to satisfy certain loan repayments, and debt service headroom requirements. Do you need to consider whether covenant waivers may be needed to be obtained from the lending party, or whether certain terms should be renegotiated or reset to reflect the changed environment? Do you need to refinance in the near future, and what might a lender require or ask in order for you to do so? And how resilient and adaptable has the business been to satisfy those questions? It's important to engage with lenders early so that they understand your position and outlook. I'll now break back to Kristan to explore further some of the valuation methodologies and current environment considerations. Kristan.
Thanks, Ed. It's helpful to think about some of those specific asset classes other than equity holdings, which I will now try to run through. So first of all, we most commonly come across net asset valuations for investments when the investee company is a private fund with its own investments. The NAV approach is acceptable as long as the underlying assets and liabilities of the fund are themselves carried at fair value, and any significant costs to realise the investment have been taken into account. Whilst adopting NAV may seem like a relatively straightforward valuation basis, it can be difficult if the NAV of the fund is not available at the same date as your year end. In this case, you will need to undertake some work to consider the likelihood that the underlying fair values haven't changed significantly. This should consist of inquiring as to whether there have been any specific developments in any of the underlying investments within the fund, and also more general consideration of movements in multiples or valuations for listed peer companies in the same sectors as the underlying investments. This is in order to identify any sectoral trends that may have caused an increase or decrease in value since the underlying investments were last valued. Under the market approach to valuation, which relates most commonly to either the use of which most commonly relates to the use of available market prices, being the level 1 quoted assets mentioned earlier, or the application of revenue or profit trading multiples for listed peer companies, or of the multiples used in disclosed comparable corporate transactions. In the current environment, you need to be careful when obtaining this multiple data. For businesses that have suffered due to COVID-19, current valuations may equate to relatively low multiples of 2019 results, because value is adjusted to expectations of 2020 performance and beyond. As such, it may be more appropriate to use forward multiples in the current environment, as they are calculated based on latest forecast earnings, the date of which you should be able to check in order to be comfortable that value reflects COVID climate expectations. We heard from Peel Hunt on our new reality webinar yesterday that FTSE average price earnings multiples are currently at a relatively high point, most likely indicating that the markets have adjusted somewhat to value businesses on a medium to long-term basis rather than on their reduced short-term forecasts, at least to some extent. When using, now look at discounted cash flows, and for valuations based on this method, the key risk is the ability of the company to accurately forecast its performance. This is true of businesses experiencing a temporary boost in demand, as much as it is true for businesses that have been restricted by COVID-19. At this stage, there's no consensus on how the global economy will recover, as there isn't yet any clarity on how long COVID-19 restrictions will be required and whether there'll be a second wave of lockdowns, and who knows what else. This uncertainty creates forecast risk and means that investors will generally demand higher returns. So discount rates applied in a DCF are going to need to incorporate a premium to reflect this incremental risk. When preparing or assessing forecasts, it's also wise to consider different scenarios, sensitizing key assumptions in order to understand how much of an influence they have on the indicated value. This will help you to assess your own confidence in your fair value estimate by giving you a likely range of expected outcomes that you can then rationalize. It's not uncommon to see a discounted cash flow model used to value an early stage business, as current earnings may be minimal, and so it is felt a multiple approach doesn't reflect the commercial value of the business. However, forecast risk is typically very high in these circumstances. So another or complementary approach is to consider the achievement of milestones as a business moves from its early stages towards a forecast position of profitability and the related future valuation. Documentation is key in this approach, and that is the documentation of expected key milestones at the point of your investment, in order to give a timeline against which actual development can subsequently be measured. Ideally, these milestones would be based on recognized benchmarks for the relevant industry, for example, securing a license or certification for a product. In the current environment, achievement of such milestones is still relevant, but please don't lose sight of the macro environment that the company is operating in. If the market has contracted due to changing consumer preferences, or if the sector is dependent upon sales to the public sector, where funds may now be diverted, then the outlook, even once milestones have been achieved, could be significantly different to that originally expected and may no longer be as positive. Another key facet of the IPEV guidelines is the use of peer company data, and we've referred to it a couple of times already. This is where you consider the movement in valuations of listed companies with similar characteristics to the investee company. Calibration is where you consider the price that you paid on entry, typically the revenue or earnings multiple, and compare it to the multiples of the peer companies at the time. This helps to ascertain whether the investee company attracts a premium or discount to the multiple of the peer companies that can then be applied at future measurement dates. The selection of peer companies is inherently judgmental, as rarely, if ever, do two companies have exactly the same characteristics. So this is again an area where documentation of your rationale for selection of peer companies is important. Consistency in the use of peer companies from period to period is also recommended, although changes may be appropriate but will require justification. Typically, you would seek to identify companies selling the same or similar products to the same or similar clients in the same or similar markets. However, even with many similar commercial characteristics, peer company valuations may be affected differently in the current downturn. For example, the peer companies may have significantly different balance sheets. So we would just highlight that it's important to take time to review the peer companies and to reassess whether they remain as appropriate as economic conditions change. Ordinarily, recent transactions can be a starting point for valuation under the IPEV guidelines. For example, where the private company issued shares during the year. But even in normal circumstances, a key consideration is whether there are indicators that value might have changed significantly since the transaction date. And in the current situation, this may well be the case. As a result, value will need to be adjusted, perhaps by means of an assessment of movements in the value of the listed peer companies. In the changing conditions that we're currently experiencing, care also needs to be taken when using this approach to ensure that there is comparability in the nature of the recent transaction. For example, was it a rescue package to provide sufficient working capital for the business to survive? The new shares issued in these circumstances may also have preferences that mean they're not sufficiently comparable to your own investment and may even adversely impact your own value. So we've touched there quickly on the most common bases for valuation and some of the particular challenges posed at this time. But valuation of investments is difficult at the best of times. And Ed will now give us an overview of the common challenges that we come across when reviewing client fair value estimates.
Thanks, Kristan. So, as I'm sure you have heard so far, when considering asset values, there can be a lot of judgment and estimation to be applied. A number of different approaches and differing inputs with both complementary and contradictory information sources. We often see that there can be both conscious and unconscious bias when considering asset valuations. For example, being anchored to a historic cost or transaction, or a fixation on acceptable price to the current holder rather than a market participant view. It is important to really consider the outlook for the asset and compare to the appropriate benchmarks. It is important to ensure that you have considered the full facts and circumstances of the particular scenario at the current time in recognizing the result, and therefore clarity is needed around how factors have been evaluated in a consistent and objective manner. Therefore, it is often useful in real time to document the approach and considerations, so that the judgments and estimates made by management based on the information available at that time are judged in the right context and without the benefit of hindsight at some subsequent time, and B, to ensure that a clear, consistent and orderly approach has been thoughtfully adopted and applied. So, what does good look like? As ever, the approach to considering value should start, at the point of investment, not with a preconception of what the end value could or should be. This requires understanding of the nature of the asset and considering all of the relevant information available in order to understand its value. Understanding what drove at the point of inception of the transaction, whether that be a stage of development, credit risk, forecasting risk, or market environment, and how this might compare to peers or instruments with similar characteristics. This should act as a consistent baseline going forward for continuing to evaluate the asset in question, while keeping a steady baseline of how the view of value and return originated. Consistently applying a methodology and objectively updating inputs to reflect changes in the asset itself and changes in how the market may perceive similar assets. Ensuring that the evaluation is from a market participant perspective, rather than being anchored to an own or in-house view of what would be an acceptable price on which to transact. And learning from realizations to understand how those differed from estimates and why. I'll now hand you back to Kristan to wrap up.
Okay, thanks, Ed. So Once again, we've covered a lot of ground in a short space of time, but we hope that as you exercise your director's duties and consider what is most likely to be one of, if not the most significant caption in the financial statements of your companies, you'll bear some of these points in mind. As with the previous 2 webinars in this series, documenting your approach and the reasons for your decisions is an important defense should you ever need to justify the values that were reflected in your accounts. We also previously discussed that when trying to assess solvency and the ability to meet future liabilities, it's important that assets are valued realistically in terms of the proceeds likely to be realized, which should correlate with fair value principles. The fundamental approach to assessing fair value has not changed due to the current economic downturn, but the inputs to your calculations are likely to need greater scrutiny this year in order to ensure that they're being applied properly. As ever, if you have any questions following today's webinar, please submit them to webinars@kpmg.co.im. This is the last in this mini-series focused on the current TCSP issues, but if there are other areas that you would like us to cover in future, then please let us know and we can consider them. Many thanks for joining us, and also to those who've presented with me over the last 3 weeks. We wish you all the best for the coming months. Thank you.
Thanks.